Let's get it started. So, the agenda for today is, of course, NFP and ISM, the implications of that, how the market reacted to it, how the market was trading into it, and the possible implications in the next couple of days. Of course, starting next week, because today is Friday already, the day is nearly over. So let's first of all get through the numbers real quick. We got NFP today at 216k versus 173k last time. That was revised down, same as the last 2 months, from 199k. Last 2 months revisions down 71k if I'm not wrong.
Yep, 70k down in total revisions.
Yeah, that's quite a bit. The earnings month over month up 0.4% versus 0.4% last time, so it's unchanged. 0.3 was expected, so it's a little beat to the expectations. Unemployment rate was down. Oh, sorry, no, it was unchanged.
Unchanged,
Yeah, it's unchanged, but it's 0.1% lower than expected at 3.7%. Participation rate is down 0.3% as well, which is quite surprising, to be honest. Nobody thought that participation rate is going to go down. But that's what it is. And then 1.5 hours later, we got ISM. ISM services report, that is, and the headline came in at 52.8 versus 55.5 last time, so down quite a bit. The biggest points to look at was unemployment, the employment index, down at 43.3 versus 50.7 last time, which is quite the dip. New orders and prices paid are down as well, but still above 50, so not too bad. Yeah, I think that's it for the number overview that we got today. Let's have a check what the markets did into the numbers. Here on the
Yeah,
chart.
before we get to that, I like to mention here that we are having quite a bit of divergence in numbers with NFP and everything else with the picture they're painting.
Yeah.
Employment in ISM services is 43 versus 50 last time. Employment in ISM manufacturing that came out on Wednesday was 48. So they're both contracting month on month below 50. Yet we have a seemingly sizable beat in NFP, but I don't really like that we are having divergence again. And if you recall, last December when the jobs report came out, household survey had 700,000 upward revisions to the history. And then again, this time we had 700,000 or so downward revisions again in household survey. So labor data is, at least there are two categories of data that are pointing in two directions, which is one is NFP and jobless claims, and the other is ISM data, employment, and the new job openings. What's that called?
Yeah, jolts, I think.
Yeah, jolts and the quit rate. So we have quite a bit of divergence in the data, which I'm very unhappy about. But yeah, continue.
No, it's all fine.
Yeah.
But we can get to that point a bit later. First of all, let's look what the market really did into the numbers today. Here you can see the Dixie chart, US dollar index, 5-minute chart intraday. So we started the day right here on the yellow line and trended up all day long into NFP actually. And the good spike up on the NFP report that was pretty solid on the wage numbers, but then faded down. As you dig into the report, it's not that good as it looked on the first look. So we're trending down, and then ISM hit, which was really bad. Dixie down quite a bit, US dollar down across the board quite a bit. Then finding a low. And then
there was no catalyst in that, right? No speakers or anything.
No, it was just it was actually into the London fix a bit, you know. It was just the time into the London fix. If we look at bonds did quite the same. If we look at the U's here, we trended up a bit all day long into NFP and then a big spike up, then the big move down, you know, on ISM, and then I'm back up again. So in my opinion, you know, there was something for everyone today on the data.
Or nothing for everyone.
Oh, it was absolutely insane. Volatility was quite big. If we
Yeah.
look here on the dollar yen, it was just nuts. We started the day right here, 144.6. We trended up all day long into NFP already, hitting a high of 145.36. That is up like 70 points already, 70 pips on a day. Then NFP hit, and we really hit through that 100 pips mark on a day. And then we just turned down the 200 pips to the downside, found it a low for whatever reason, and rebounded that all of that 100 pips dip on a day, and we're back like sort of flat on a day, right? If we look at the daily, it's just flat, right? 200 pips range, a bit more than 200 pips, but it's just flat on a day. So what are you gonna do with that? That is just, just nuts. If we look at equities, let's have a quick look at SPX. That is actually trending down.
But still on the day we are about flat right now.
Yeah,
Where
we're about
SPX is down 2.5 points on the day.
As you can see, the yellow line is yesterday's close. We're about flat on the day, sort of. It was high already, faded down. But yeah, pretty much flat on the day. If we check the daily chart, that is actually not too good looking. In my opinion, that looks like sort of a top here and a breakdown of that little double top.
Yeah,
Right?
yeah. The on ES 47.37, that area ish has channel bottom on the rising thing, and we broke down. We tested it and we broke down again after breaking back into it. So this does look like a breakdown, but we shall see. I don't believe it. Have CPI coming.
Remember that suspicious sell-off to the downside
Yeah.
late December? Everybody was like, oh, there's a sell-off with no reason. And of course, we reclaimed it. But just above it and now selling off again. That looks certainly like a technical break, just liquidity break below this one here. In my opinion.
Yeah.
Liquidity taking below the lows and then, finding here a bottom a bit after the really bad ISM report. That should not be too good for risk. But of course, bonds up, risk up as well. That is the current play. So
Like December is also down like 2 basis points. So we priced some like 10 basis point cuts after NFP.
Yeah,
Then we priced back in. We priced them all back in. Then we priced back in another 10 basis point cuts. And now we raised everything and we are flat on the day, as if both of the data like canceled each other out.
Exactly. This is the contract we want to look at. Set Q set for 2024. So this is end of the year 2024.
Yeah.
Fed outlook, Fed rate outlook, the bond outlook, and this is as you can see flat on the day really, with a big range today. So it was really something for everybody, I would say, for both sides. But at the end of the day, we are flat. So what are we gonna do with those reports, right? You said there's quite a divergence in the
I don't know what
sector.
to believe. I don't know which one to believe. I don't know which picture to believe. I want to believe the ISMs, but I got fooled by ISMs December 2022. We had this picture again. ISM services was tanking, and that turned out to be fake.
Yeah, everybody's always saying ISM is probably the best forward-looking indicator we have. But is it really, right? Is it really?
For me, it is. I mean, it's still the best one that I can think of. Okay, so like I said, something that caught my attention this week, so I think it was Bloomberg posting it, like the quits rate. The quits rate. People quit if they feel the jobs are abundant, they feel safe quitting. That is finally to pre-pandemic levels. Quit rate has been steadily trending down, and we are finally at 2019 levels.
I probably have an idea of what is really happening, to be honest. I mean, there is one scenario I can think of that would fit the picture, and that is more rotation in jobs, right? That would mean labor force is probably going down a bit, and employment is still steady, just because there's more rotation in the job sector. You know what I mean? So people are quitting one job and then getting into the other jobs. That's why we have a lot of volatility as well in the data. But that is why NFP is probably strong, because that is, just the hiring, right, and not the firing or the leaving. But then on the same time, you have the jobs quitting up quite a bit as well.
No, the quits are down to 29.
Oh, that is
So
down.
people
Okay.
stop quitting. People quit more when they feel confident in the market.
Yeah.
When they feel that they can get better raise, when they feel they can get a better job, they quit more. Now they're quitting less because they're like, the higher the quit rate, the stronger the labor market,
Yeah.
because people are quitting and negotiating for higher wages. That is down to 2019 levels.
But that would also mean that the job market is at the moment pretty loose, pretty, not too tight.
It's a good place. 2019 was a good place. It was tight-ish, but it was not too tight. But that would actually also.
Hello? You're still with us, tell him. I think we got some connection problems there.
So the gains are in part-time sector.
I think you're
Yes,
back.
exactly.
I think we got some connection problems there. Can you hear me, guys?
Yeah, it does look like we have some connection problems.
Now I can hear you again.
I mean, I've been able to hear you fine all this time, but I have not heard from them until just now.
Paul actually muted himself. I cannot.
Oh yeah.
I cannot put that up.
Guys, I think the connection problems are on my side. Do you hear me?
Yeah, we can hear you.
Pretty bad, to be honest, but I can hear you.
Okay, great. So what I did say is exactly that the part-time jobs are becoming rising stronger than the full-time jobs. So that's a strong sign that the labor market is, moving in the right direction. It's slowing down.
Yeah.
It's not as strong anymore, but it's slowing down at a good pace, I would say. It's not crashing. It's like a steady slowdown. So that's not a really bad sign.
Yeah, not a bad sign in the lagging data, but we have new orders on ISM services. That is still at a good place. 52 is not bad, but it's also not like hot economy.
Yeah, I agree. The report today from Wells Fargo, I found it really logical. It's if you take this report for itself today, then it's bad, but it's just one report. So in the overall picture, it's still okay. It's still everything is slowing in the economy, but it's still okay. It's still going great, good. And the report itself today, it could be a one-off report because of the really, really weak employment number. It was especially weak. It was the second weakest since 2009, if you take the Corona days out. So let's see next month if it gets if it confirms this weak report today. Then it gets interesting. Then it gets really interesting.
Yeah,
that's fair. We are not really seeing any labor market problems and jobless claims. That has been getting strong again.
Yeah, that is trending up again. Sorry, down. So jobless claims are going down. The follow-up jobless claims are going down as well, trending down over some time now. So the continuing claims, which is pretty interesting as well.
So the summary is things are fine.
Yep, I would say so.
Yes.
Yeah, things are fine.
I agree.
So that leaves Fed on like a June cut timeline, not March.
Yeah, I too think March is just way too early to tell for now. If we look at pricing, we can check the pricing real quick as well.
Do we have a meeting between March and June?
There
Let's see.
should be.
Let's see.
Yeah, there definitely should be.
We have one in May.
Yeah, there should be one
okay.
in May.
May
Okay.
1st.
I think this one will be really interesting. Yeah.
Yeah. So for now, as you can see here, the pricing for March is for one cut currently 62%, 33% chance to hold unchanged in March 20 meeting, and then in May we have, well, actually the forecast right now is more for two cuts until the May 1st meeting at 51%, and 38% chance that we just get one cut from here to May 1st. And then for June, it's already down to 3 cuts, 50% nearly. So yeah, March is still here for one cut. Actually, the market is still pricing in one cut in March meeting. I think that's too much. To be honest, I think that's too early.
Yeah, I don't believe in the March cut.
So if we look at the markets, if we look at what's up next on the data front, I wrote it down a bit. Next Monday we have Switzerland retail sales CPI, EU retail sales. Then we have in the night from Monday to Tuesday we have the Japanese CPI and also the Australian retail sales. On Tuesday we have a 3-year bond auction, US one. Wednesday we have a 10-year US bond auction, and on Thursday we have the big day US CPI, jobless claims 30-year auction, and in the night from Thursday to Friday we have the China CPI, and on Friday to finish it off next week we have the US PPI and University of Michigan Consumer Index or Sentiment Index to finish it off.
And Saturday we have Taiwan elections.
Yeah. That is on the geopolitical risk as well.
That is the one I'm watching.
Yeah, because you're long in China. That's of course something you're gonna watch. But I think all the eye is gonna be on Thursday US CPI.
Oh yeah, of course.
That is gonna be the big risk next week. Along with the bond auctions probably 10, as I said, 3-year, 10-year, and 30
years. 30 year, 10 year.
30 years is gonna be interesting. That is after CPI, by the way. So that is Thursday afternoon after the CPI. So that is gonna be interesting.
I think CPI is gonna be good. I don't see any reason to think CPI is gonna overshoot. I think the CPI is gonna be good, and I think we're gonna have dovish moves leading into CPI.
Dovish moves on what?
Everything.
Equities.
Big stocks,
everything?
like lower yields, lower dollar.
So you think CPI will be in line or undershoot?
I think people will position for an undershoot, and I think there's an asymmetrical chance of an undershoot versus an overshoot. But yeah, I expect positioning for an undershoot into CPI.
Okay.
That's quite interesting because that's actually not what I'm expecting, to be honest. I think the market is going to position a bit more hawkish into it. Yeah, to take some risk off. I think the market is well positioned for dovish CPI for the Fed pivot, and I think the risk is clearly to the upside that the CPI is going to overshoot, not undershoot. Undershooting a miss in CPI would just confirm everything. So I think the market is, but that is probably too early to play out Monday, Tuesday, probably still Wednesday. But I think,
yes,
right before CPI, I think the market is gonna go and hedge a bit into the CPI numbers. So the market is probably, bond selling off a bit.
Yeah, I have the opposite view. I think we're gonna start positioning from Monday until Thursday with dovish moves. But yeah, I am not going to be actually betting money on any of this. I'm not really trading actively, so don't take my word for it.
Yeah. Yeah, sounds good. Sounds good. We still, as I said, we have some other numbers to watch as well on Monday. European retail sales, Swiss retail sales, and CPI. And also the Japanese CPI. What are we going to think about Japanese, man? They have a rough start into 2024. First and
halfway. I don't think that was a big deal.
No, I don't think so either. That is a good deal for the market. But what are we going to think about Japanese? I mean, the yen did quite the run in early 2024 now. The yen is up what?
In my opinion, the yen is often weak at the start of January. Maybe there are some outliers, like in I think 2019 when there was a flash crash early January. But normally I think it's rather weak. And I think everyone expected so from December on that the BOJ will hike rates sooner than everyone thought, like maybe in January even. But that has now become like no way they will do something in January. So if you're shorting the dollar yen, then you always have to have in mind, okay, if they hike rates maybe in May or June, then I have to pay the carry every month, and it's become expensive. So rather I will short it way later. And so yeah, it's hard to go long on the yen when the BOJ is so dovish still, and or the Fed is still not as dovish as the market wants.
Yeah, fully.
I agree. I hate JPY.
But the thing really is, did we have a top today, right, until CPI? Because that is the question that is actually making money in the next couple of days. We had quite some resistance building up here, 145. The round number, the big number, you can also see it on the weekly. Quite a big level down up here, 145. We broke above it, rejected it, but we're still claiming onto it, right? So what are we going to do with the dollar yen? Is it still going to rise next week? I mean, if you're expecting dovish moves across the board, you will certainly sell the dollar yen as well, right, into CPI.
Yeah, that's my base case. I expect dollar weakness, especially on dollar yen.
Yeah, in the end, of course, the CPI will decide. So if it's hotter, then of course buying dips in dollar yen will be a great trade. But yeah, I think it's a 50-50 short right here. It was a great trade from the start of January, buying it right away. But right now it's 50-50 for me.
Sounds like a plan. So I'm staying away from the dollar yen, to be honest. I don't want to trade it.
When exactly are the Japanese CPI? Are they Friday?
No, from Monday to Tuesday in the night.
Ah, okay. Okay, that's interesting.
Yeah. So it's just 3 more sessions until it hits.
The Japanese CPI, but these are the national figures, yes?
Let me check.
Not Tokyo, right?
I have no idea, but I think
it's just Tokyo CPI.
Yeah,
on Tuesdays,
so well.
Tokyo CPI.
Okay. That's more interesting because that's the first one always, and it correlates like 80-90% with the national ones.
Yeah. It should be the first meeting for December.
I don't really trade or watch Japan. I have no idea what the hell are they doing. I mean, they literally managed to keep their negative rates through the whole worldwide hiking cycle, you know? And I don't think they're eager to actually hike. I don't think they're eager to hike at all.
They don't want to, but at some point they probably have to.
Maybe they're like, fingers crossed, worldwide inflation coming down is going to save us as well. Because their fiscal situation is untenable if they actually go even a little bit above in rates sustainably.
Yeah. The question I ask myself is, at some point, the inflation numbers in Japan will also become really sensible to base effects. So their inflation started way later, but it has then will come back later down. So maybe they will be lucky and they don't need to raise at all. But then the yen will be hammered again. It's a $1 million question.
Yeah, my base case for Japan overall for their hiking cycle is they're gonna raise their band around their yield curve control by another 50 basis points, 150, and they're going to hike rates by 10 basis points to 0 from negative 0.1, and that's going to be the end of the hiking cycle for BOJ.
And in your opinion, what would they do with the yen? Would it be enough to strengthen?
No. Yen, I think, will middle around 140s until the rate differentials get much lower. I think the yen move, the carry trade cost will keep the dollar yen high until the Fed rate gets lower. I don't think there's like a runaway bid that's coming to yen. The carry trade is just too expensive.
Yeah, the question is if everything of that is playing out and the Fed is cutting rates, let's say 200 basis points this year, which is quite a bit, right?
Yeah.
And let's say they are cutting down to 2.5% overall over the next 2 years, right? That is quite a bit because that's 275 basis points overall. That is still quite a bit of a rate differential after that, right? So is it going to be enough?
Yeah, but you have to look at like a 2019.
Yeah.
What happened to yen at that time?
We can check it. 2019.
Yeah. I think in 2019 we had the exact rate differential of the Fed had like 2.5 maybe. And so at these times the yen was like 110, 112. So I don't think we get back to these levels, but 125, 130 will be possible.
Yeah, I agree. I think we'll get to 120, 125. I think that's possible after all of these cuts materialize.
Yeah.
Yes.
That I can agree on. So the next 2 years probably we go down a bit, maybe 2,000 basis point, 2,000 pips, $20 down here, probably, but not a lot more. I don't think we're gonna break this range here, 128. I don't think we're gonna go below that one. That's the low we made in 2023, which is at 127. I don't think we're gonna go below that, to be honest.
Yeah, that was a thin liquidity move also. That was, I think, like beginning of January.
Yeah, that was just beginning of the year as well. And it took it out.
Yeah, okay. Yeah. I wouldn't read too much in this move. So, yeah, I also think 130 is a good target point if the Fed really cuts like 200, 300 basis points.
That is a long way, though. That is a long way, and a lot of things can happen. Okay, guys, we are down at 28 minutes recording for this podcast session. Is there any questions left you want to ask? I want to make this, like an open.
Okay, when we will get more clarity about U.S. labor market instead of inflation? What's the next important data bit aside from jobless claims? Do we have anything on the horizon?
Good question.
Let me think.
Like we go month to month from ISM to NFP to CPI and other PMIs. Other than that,
I guess it's
I
just
don't like the JOLTS indicator, but the market listens to it. But we had it like last week, this week.
Yeah. Everything happened within like a week. We had everything this week.
Always
so we have to wait another month.
Yeah, it's always the first week of the month, right? NFP is always the first Friday of the month, and then ADP and JOLTS, that is all in the same week as NFP, so it's always the first week of the month where everything is going to play out on the employment.
I have to wait then.
Yep.
So that's the employment week always,
Yeah.
And nothing aside from that from me.
In between, we just got the jobless claims, right? To look at.
Yeah.
Is there any other questions left? Is there anything else you want to cover? Did we miss
when are earnings? They have also good commentary about the state of the economy.
Oh, no idea.
When does the earnings season start?
No idea.
Because I mean, the companies have a lot of commentary about the state of the economy. Consumer companies and stuff like that.
That is true. It's true.
It feels like it's been a while since last earnings, so I think like the next one should be around the corner. When is Wells Fargo earnings?
Well, it's usually pretty early in the first quarter after we close down the last one, so it should be pretty soon. It should be in January, probably. Maybe
January
end of-
12th, 2024.
Yeah.
Okay, we are entering earnings season. So next
Yeah.
week, bank earnings are starting. Okay, I said it feels like it's been a while. So it has been a while. We are starting the earnings season next week.
That sounds like a good deal as well.
Yeah, we start with banks. So we're starting entering earnings season. So aside from this week's jobs data, we will get a lot of commentary about the state of the economy from banks and everyone else from next week. That's perfect.
Let's see if bank deposits are going down as well again.
I mean, bonds rallied. Hopefully not.
That will be quite something. That will be interesting again. Let's make it a recap of 2023 and just get another banking crisis early in the year, first quarter. We'll say something.
Which bank this time? UBS or maybe Deutsche Bank?
Let's take the Italian ones first. That's what I want to see.
Unified, okay.
Let's get Santander on top, and then I'm happy.
Poor Giuseppe. Poor guy.
Okay, guys, it was quite fun today. I think we covered pretty much everything we wanted to talk about, and that's how I want to close out the first episode of the podcast. And gonna see you next time.
Have a good weekend, everyone.
Thank you. You too, guys.
Yeah.
Have a great week. Bye bye.